that brings us to behavioral finance. This is one of my favorite topics because this is the one thing that has the biggest impact, in my personal opinion, on investor returns. So while all of the other stuff, the asset allocation, it makes a difference, a significant difference, it doesn't make as much difference as this does. So the question here is, and you have to know that there's been 2 Nobel Prizes given in behavioral finance since 2000. So it's considered a very serious part of economics, and I thought we might want to take a look at a couple of them. So let's start with the over-optimism or being stuck in the gifted program. So essentially, the way this works is 80% of us think we're in the top 50%, and you might say top 50% of what? It doesn't matter. You think you're in the top 50%, 80% of you, of anything. You're better looking, you're a better lover, you drive the car better. It doesn't really matter what the question is. That's the answer to the question. And this book here by James Montier, great book, really quite funny, explains all of the issues regarding behavioral finance. I recommend you get it. It was written years ago, but the theories have not changed. And one of the things he says in the book, so he's talking about our industry, fund managers. Now, remember I said 80% think they're in the top 50%. Well, we are better than that. Because in that 300 fund survey, 76% of us said we were above average, and the other 24% said that we were average. So in our world, 100% of us are average or better. We are wonderful people. Yeah. And then the deadly trio, which includes cognitive dissonance, so I agree with every fact that agrees with me. So really, that's a filtering mechanism that one puts once decisions have been made. And it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so, Mark Twain. Confirmation bias. So what you're looking for is more information that agrees with what your current position is. It's also similar to something called anchoring. And overconfidence, or a bridge or an apple too far. And then one of my favorites is this one, gambling with house money. How many of you have been to a casino or oh, come on, be honest. Okay. All right, so only once in a while when you go to a casino are you lucky enough to actually win money from the casino at the beginning of your trip. But I bet you if you've been more than a few times, that's actually happened. And what happens when you win money from the casino early? You get more aggressive with your betting. You say, let's up the minimum bet. Why? Because as far as you're concerned, you're playing with house money. What happens psychologically is we say, I've got $2,000 in my pocket. I just won at blackjack or roulette or whatever. I'm playing, this is free. I'm playing with free money here. It does not occur to you, this is actually your money. You could walk out that front door and that would still be your money. No, it's staying in my pocket. And when I walk out that door, it will stay in the casino as well, because basically you will figure out a way to lose that money before you walk out that door. And this is what people do with investments. So when markets rise, people get more aggressive. They double down on their bets. And when markets fall, they get nervous and afraid, which comes into an issue called loss aversion. If you're in a position of losing money, let's just imagine how markets looked at the end of last year. If you have a loss or the potential of a loss, you feel twice the pain, it's measurable, as you do joy from winning money. So basically, if somebody gives you a bet, they have to give you twice as much upside to make you overcome the pain you're feeling from losing a dollar. So why do these things make a difference? This is what it looks like when you put it together. Markets are rising, let's say like they did last summer, makes you think, I'm brilliant. And then, of course, things get a little wobbly and you start to get nervous, but you're still in the game. Until, of course, the markets maybe cratered 20 or 30 or 40% like it did in 2008, and you say, I'm never going to do this again. Now, what happens here is this. Your highest risk is when you're happiest, and your lowest risk is when you're saddest. So the hard part in behavioral finance is this. Another great book, this is a psychologist who wrote this book. This is a great quote, by the way. He who conquers himself is the mightiest warrior. Well, that's what this book is about. So this guy, Daniel Crosby, this book only came out a year ago, both a psychologist, actually, and a very good investor. And really what it comes down to this. Can you sell when you're winning, and can you buy when you're losing? And you have to be honest with yourself in this one. Could you really do that? Because that makes a difference. Now, how much of a difference does it make? Dalbar does a study every year, and it's interesting, they updated it for this 2018. And what they do is they measure investor performance against the S&P 500 and seeing how much the investors lag. And I've used this line before, but I don't mind repeating it. So you have to appreciate that they're looking at tens of thousands of accounts. So statistically, this group of people, it's impossible for them not actually to get the market return. Statistically, it's impossible. If I think the frame I've used before is if they were 10,000 lobotomized monkeys throwing darts at pieces of paper, they would get the stock market return, because it's just statistically the averages. That's all it is. But they don't do that. They actually get a return 3 to 5% per year lower than that. So something else is going on with these people. It's causing them to make their own returns drop. And is this consistent? Let's just take a look at last year alone. Last year, the stock market in the States in US dollars lost 4.38%. The average investor, 9.42%, 5% worse in one single year. So when I say that this is the biggest thing that can impact your returns and the biggest thing you want to get your head around in terms of trying to conquer outcomes, this is huge. And I could have done the same statistics on fixed income and bonds, and we would get similar results.